Hey there, Rainbow Warriors. I'm CJ, host of Beyond the Rainbow, True Crimes of the LGBT. My episodes focus on crimes committed by and against the LGBTQ community. I've covered cases you probably have heard of, such as Matthew Shepard, Brandon Tina, and the Orlando Pulse nightclub massacre, as well as some lesser-known cases like the murder of Ray Hainish, the Australian gay Beatz murders, and the suspicious disappearance of Lisa Lynn Stone. I cover cases brought to me by listeners like Penny Brummer, who I believe was wrongfully convicted, taboo cases such as lesbian corrective rape and murder in South Africa, and Pray the Gay Away camps. I discuss gay serial killers, women who pretend to be men to hook up with other women, and trans murders. I'm opinionated and uncensored. I know I'm not everyone's cup of tea, but surely I'm someone's shot at tequila. No matter what your gender or orientation in life might be, please join me as I tackle rainbow crimes in search of unicorn justice. Remember, it's not a crime to be gay, unless you're a murderer.
So, did you hear about Jen Shaw?
No, I didn't hear about Jen Shaw.
How about Erica? You hear about Erica?
I don't think so.
What about that fraud shit from the other day?
Can you be more specific?
There's so much fraud out there and so much shenanigans. You should just tune into Book of Lies podcast.
Book of Lies podcast.
Every week we talk about some fraud, some scams, and maybe even some TV shows.
Where there are scams.
Yes, of course. Scams, frauds, and all those things. So tune in every week where we'll bring you a new topic of...
Scams?
That's right. Scams.
So tune in on your favorite podcatcher to catch up on the latest liars, cheaters, thieves, and dirty, rotten scoundrels.
That's right. See you soon.
Bye!
I'm Edward October, creator-host of Octoberpod, and we're both listening to Calls of Death on the Darkcast network.
Hello, and welcome to Cause of Death, 100 Seconds to Midnight. These episodes address the doomsday clock and the events that keep it ticking down, and the things we can do to stop it. The doomsday clock has been set at 100 seconds to midnight since 2020. In 2008, there was a global banking crisis that reverberated across the world. Economies collapsed, mortgages failed, people lost their homes, and subsequently ended up homeless. Now, in 2022, we're facing what could be a repeat of that banking crisis. It's 100 seconds to midnight, and across the world, economies are in peril, we are seeing violent conflicts, and the people who will suffer most are those who are on the socioeconomic fringes, those who are just barely hanging on. There have been 5 major global financial crises in recent history. The first was the credit crisis of 1772. This crisis began in London. The British had attained an overabundance of wealth through colonization and trade. British banks began to expand credit lines as overconfidence took the place of good sense. This overextension began in the mid-1760s and came to a screeching halt on June 8th of 1772, when Alexander Fordyce, who was a partner of the British banking house Neil, James, Fordyce, and Down, decided he was going to just abscond to France so that he wouldn't have to pay his debts. Rumors began to circulate, and very shortly, creditors started lining up in front of British banks to demand cash payments. They wanted these payments immediately. This triggered a banking panic in England that spread to Scotland, the Netherlands, and other parts of Europe and the British American colonies. Historians claim that this banking crisis was the ultimate cause of the Boston Tea Party and a major contributor to the American Revolution. The Great Depression lasted from 1929 to 1939 and was the worst banking crisis in recent history. From investors who had lost everything overnight to people who were just working for a living losing their jobs, the entire world was affected by the stock market crash that became known as Black Monday, October 28, 1929. Several things attributed to the Great Depression and the stock market crash, and it's important to remember that it wasn't just the U.S. that was affected. It was a global crisis. The global economy at the time was vulnerable. Farms and factories were only beginning to bounce back from the economic disruption caused by World War I. The focus of consumers had shifted from consumables to durable goods. They were buying refrigerators and cars on credit. Businesses became wildly profitable, but shortly after the boom, consumer confidence shifted and people stopped buying these products. During this period, exporters from foreign countries became fierce competitors with factories in the U.S. Nations refused to work with one another to do any damage control. It was a house of cards that was bound to fall. Financial speculation at the time was also a contributor to the Great Depression. Get-rich-quick schemes led many to believe that they could become millionaires overnight if they just took enough risk. Schemes like Florida swampland, owning the Brooklyn Bridge, and non-existent oil deposits were popular cons of the time. The idea that one could buy Spanish mail coupons to exchange for U.S. stamps while at the same time exploiting the weaker Spanish currency was an interesting scam that contributed to the failure of those who bought into the scheme. Then there was Wall Street. Investors bought stocks on margin, putting down as little as 10% and using the stocks that they had just bought as collateral against loans for the rest of the money they owed on those same stocks. The stock market soared, and everyone was making huge amounts of invisible money. On Black Monday, the Dow Jones dropped almost 13% in one day. The ripple effect from that decline destroyed almost half of the Dow's value in a month. At the height of the financial crisis, U.S. companies had lost 89% of their value. Companies could no longer finance their operations. They closed their doors and left workers without jobs or homes. The Federal Reserve System was created in 1913 and was supposed to ensure the nation's economic stability by controlling the supply of money. From 1921 to 1929, the money supply increased 67%. Interest rates declined, and people began to borrow more money and overinvest. A bubble in the stock market was created by overspeculation. Normally, this would lead to higher interest rates to keep the bubble from forming, but the Fed didn't understand that. It was still in its infancy, so they continued to lend and interest rates stayed low. It wasn't until early 1929 that the Fed began to worry about unchecked speculation. They immediately contracted the money supply and raised interest rates. The stock market did come down, but it came down too quickly. And it came down too much. The gold standard was also a contributor to the Depression. As the dollar lost its value, investors quickly traded dollars for gold. This caused interest rates to soar even higher in order to protect the value of the dollar. Those interest rates made it harder for businesses to borrow the money they needed to keep the doors open. Before the crash, Congress had enacted the Smoot-Hawley Act. The law raised tariffs on foreign goods about 16%. This was done in an effort to keep American companies from having to compete with goods from foreign countries who could make goods at a lower price. The law was written in early 1929 during the boom. but it wasn't signed into law by President Herbert Hoover until 1930, after the crash. It sounded like a good idea at the time, but other countries who were also facing economic hardship during the Depression retaliated. They put an even higher tariff on U.S. exports. These 5 things combined to create a perfect storm that led to economic hardship across the globe. Unemployment in the U.S. peaked in 1933 to an unprecedented 25%. People who had previously been prosperous were reduced to living in shanty towns. The U.S. government refused to render aid to those who had lost their jobs during the Hoover administration. The U.S. economy didn't rebound until 1940. Then World War II came along, causing more disruptions. The OPEC oil price shock began in 1973. It was started when the primarily Arab nations belonging to OPEC retaliated against the U.S. for sending arms supplies to Israel during the Fourth Arab-Israeli War. An oil embargo ensued, and oil exports to the U.S. and its allies were suddenly stopped, causing severe spikes in oil prices and oil shortages. Inflation went out of control, and people stopped buying things that they didn't need. This era was called the economic period of stagflation and would last several years before output would recover and inflation would fall to pre-crisis levels. The Asian crisis began in Thailand in 1997 and quickly spread through the rest of East Asia and its trading partners. This crisis was created by speculative capital flows into what was known as the Asian tigers from developed countries. The countries of Thailand, Indonesia, Malaysia, Singapore, Hong Kong, and South Korea enjoyed a period of wealth funded by stronger economies. This led to an overextension of credit and far too much debt accumulation. In July of 1997, the Thai government abandoned its fixed exchange rate against the dollar due to lack of foreign currency resources. Asian financial markets went into a panic, and this caused a reversal of billions of dollars of foreign investment. Markets and investors became concerned that East Asian governments would go bankrupt, and fears spread that this could cause a worldwide financial disaster. In the end, the International Monetary Fund created bailouts for the countries that had been most severely affected, so that those countries could avoid default. This brings us to the global financial crisis of 2008. Many know this as the Great Recession. This crisis began in the U.S. and spread to the rest of the world through linkages in the global financial system. Banks across the globe experienced huge losses and relied on government support to avoid bankruptcy. Millions of people became unemployed as major advanced economies were thrown into their deepest recessions since the Great Depression. Economists argue about which of the several causes finally tipped the bucket and started the flood, but they can all agree that there were several causes for this crisis. Economic conditions across the world were stable in the years leading up to the crisis. Growth was strong, rates of inflation, unemployment, and interest were very low. This caused housing prices to go up. People began borrowing more money than they could afford to either buy a home or build one. This happened around the world as interest rates dropped. Interest rates at the time were close to or just above the purchase price of a home. Investors who were more interested in short-term profits began flipping houses, and banks were allowing those who had less than stellar credit to borrow more money than they could afford to pay back. And banks were allowing these loans for several reasons. There was increasing competition between lenders to extend larger and larger loans so that they could make money. Many lenders didn't assess the borrower's ability to repay the loans correctly. They didn't expect to incur any loss because they were selling high-risk loans to the highest bidder. A home loan might be sold several times over the course of a few years. The investors who bought these loans were led to believe that the assets were very low risk. Even if some of the loans weren't repaid, it was assumed that the majority would be repaid, so they wouldn't lose anything. These investors were not only U.S. companies, but several European companies had chosen to invest in U.S. markets since the risk seemed so low. Increased borrowing by banks and investors seems to be a hallmark among causes of financial disaster. Banks around the world borrowed more and more money to invest in the housing market in the U.S. As housing prices began to fall, these investors began to lose money since the assets they had purchased were no longer worth the money that they had put into them. To add insult to injury, banks and investors borrowed money for very short periods to purchase assets that couldn't be sold quickly. This caused a revolving door of borrowing as investors began borrowing more money to pay back the short-term loans in order to avoid default. In the end, housing prices fell and borrowers began to miss payments. Before you knew it, the market was flooded with houses that couldn't be sold. Lenders and investors began to incur huge losses since the homes that were repossessed during the fall had to be sold for under the cost of the original loan. Those who had invested in loans were trying to sell off those loans as well. The loans that they were trying to sell became worth only pennies on the dollar as defaults mounted. Foreign banks were affected since they had invested heavily in U.S. mortgages. And then came Lehman Brothers. Lehman Brothers was one of the biggest investors in the housing market, and as the U.S. economy began to fail, so did this U.S. financial firm. They closed their doors in September of 2008, and they took several other financial firms with them. Worldwide economic panic ensued, and investors around the world began pulling money out of all financial markets since they didn't know who was going to go down next. Everyone tried to sell their assets at the same time, and financial institutions couldn't borrow money to stay afloat. Confidence in the system collapsed. Businesses stopped investing, and people stopped buying houses. They lent huge amounts of money to banks and other institutions that couldn't borrow in other financial markets. And they bought a lot of houses. Governments increased their spending to stimulate demand and support employment. They guaranteed deposits and bank bonds in order to raise confidence in banks and financial firms. They also bought ownership stakes in financial firms to prevent those firms from going bankrupt. Most of us think of this as corporate welfare, but governments think of it as avoiding panic in financial markets. Governments believe that these policies help avoid a global depression. These policies are still in place today. Millions of people lost their jobs, their homes, and any nest eggs they may have had. The unemployment rate in the U.S. had only gone back to pre-crisis levels in 2016, 9 years after the crisis had ended. Today, Sri Lanka is experiencing an economic crisis. Inflation has risen to more than 50%. There have been daily power cuts. Food, fuel, and medicines are in short supply. The country doesn't have enough foreign currency to import more resources. The government has banned the sale of fuel for non-essential vehicles for 2 weeks. People have been asked to work from home to conserve supplies. The Sri Lankan government blamed their economic woes on the COVID-19 pandemic. And there were several bombings that occurred in the country in 2019 that had adverse effects on tourism there. Tourism is a huge industry in Sri Lanka, and the main way that they earn foreign currency. But we can't forget that there was economic mismanagement by the government itself. President Rajapaksa encouraged domestic markets over foreign trade at the end of the Civil War in 2009. Income from exports tanked, and more money was spent on importing goods from other countries. Currently, Sri Lanka imports $3 billion more than it exports, so there is a huge gap in foreign currency. At the end of 2019, Sri Lanka had $7.6 billion in foreign currency reserves. That sum has dropped to about $250 million over the past 3 years. In early 2021, the government realized that there was a foreign currency shortage. So to counter that, they put a ban on chemical fertilizer. Chemical fertilizer had to be imported from other countries, but organic fertilizer did not. They told farmers to use locally sourced organic fertilizer instead of chemical fertilizer. This resulted in a countrywide crop failure, which forced Sri Lanka to import food from other countries, furthering their foreign currency problem. Sri Lanka had one of the fastest growing economies in Asia during the 2010s. By 2019, the economy began to fail, and by May of 2022, the government had defaulted on its debt for the first time in history. This will make it harder for the country to borrow the money it needs on the international markets. Confidence in the country's currency and economy is tanking. Prime Minister Ranil Wickremesinghe was named as interim, but the protests and the problems continue. Inflation has risen past 50% and could rise as high as 70%, making it almost impossible for people to survive. In his first act as president, Wickremesinghe immediately declared a state of emergency across the country and imposed a curfew in the western province, while he continues to try and figure out how to stabilize the situation. The country owes more than $51 billion to foreign lenders. China is discussing restructuring its $6.5 billion loan to Sri Lanka. The World Bank has offered to send Sri Lanka $600 million, and India has offered a loan of $1.9 billion. The International Monetary Fund is considering lending the country $3 billion, but none of these things will happen until the government stabilizes and they raise interest rates and taxes to fund these deals. Political instability and food insecurity must be dealt with before funding to Sri Lanka will be available. Some of the problems in Sri Lanka have occurred because of unchecked borrowing from China. That money was used to fund infrastructure projects that failed. The currency has collapsed by 80% over the past year. Before the IMF will help Sri Lanka restructure its loans and bail them out, the country may have to also privatize several government-owned businesses and restructure government policies to include spending cuts. 1/3 of the country's 22 million people work in government-owned and operated businesses. Spending cuts could mean layoffs and job losses for many of these people. Wickremesinghe has announced that the government would print more money to pay salaries, but that would only boost inflation. He's also asked Russia and Qatar to sell fuel at a lower price in order to bring down the cost of petrol. Meanwhile, the country's foreign exchange income, which amounts to about $1.5 billion per month, will have to go to imports like food, medicine, and fuel. Deficit spending will have to increase in order to provide relief for families who are suffering in the country. President Rajapaksa also introduced huge tax cuts in 2019. These cuts saw government income losses of more than $1.4 billion a year. The tax cuts were reversed before Rajapaksa left office, giving the country $2.2 billion in revenue, But those reversals come at the expense of people who are already struggling to survive, and they won't boost the economy enough to help the economy recover. The country desperately needs new forms of revenue, but those won't come without a stronger economy. It's a catch-22. One thing can't happen until something else happens. The government has also given up on organic farming. That experiment cost the country 16% of its most valuable export, tea. Domestic rice production also fell by a third. It will take years for farmers to recover from the experiment, and farmers are demanding stimulus money to help recultivate their crops. Money the government doesn't have. Tourism was the country's biggest producer of foreign currency, and even before the pandemic, civil unrest, government instability, and violence severely affected that source of revenue. In the last year, Sri Lankan government has also set the foreign exchange rate of the rupee to an uncompetitive price. What this means is that expatriates who are working abroad and sending money home to their families don't use formal government channels to send that money. They bypass the government and pay a middleman to send the equivalent amount of rupees to their families. Since the Hawala system has been in place, the government has lost roughly $500,000 a month in income. Without a bailout, the economy will continue to collapse, and the consequences could be dire for the people of Sri Lanka. China is also facing a financial crisis. Several housing developers in China defaulted on their interest payments in 2021. This led to a slump in the housing market. By June of 2022, home sales were down and prices fell. Construction dropped off, property loan growth slowed, and consumer confidence tanked. Protests were held over the mortgage crisis and the banking crisis, even though the market seemed to be stable. Poor capital turnover, liquidity stress, global and domestic economic slowdown due to the zero COVID-19 policy in China, not to mention the Russia-Ukraine war, has brought stress to the Chinese financial system. China's banks and real estate markets are highly interconnected with the global markets, so if China feels a crunch, we could all feel it. On July 10th, over 1,000 people staged a protest at a branch of the Bank of China in Henan. They wanted the money they had in savings at the bank returned to them. In the end, protesters were violently beaten by unknown men in white shirts. Since then, several protests have been staged at local banks across China. Chinese banks have been plagued by risk caused by increasing housing prices, policy uncertainty, and shadow banking. This crisis began in Henan's provincial capital of Zhengzhou, where currently over 40 billion renminbi is missing from bank deposits. 5 banks in the province notified customers that their accounts had been frozen and they wouldn't be able to withdraw their money. A private firm, Henan Zinkefu Group, had stakes in all the banks and had embezzled funds through fabricated loans and internal and external collusion. On top of all of this, clients are now boycotting loan payments since developers have run out of money to finish building projects. Not only are the developers and clients defaulting, but suppliers of building materials are as well. This has also resulted in losses in bank shares. In the end, China's banking system could be burdened with $58 billion in non-performing loans. This could cause instability in the banking system worldwide. Beijing banking authorities are between a rock and a hard place. If they ease lending regulations for home buyers, the home buyers may take unfair advantage of the government guarantees. But if the banking industry restricts withdrawals, it could cripple an already unstable banking system. In the U.S., we've experienced another housing bubble that never ends well. Investors again charged in to buy properties well over market value, causing a housing crisis nationwide. That bubble has burst, and with buyer confidence down, those properties can't be sold for the prices that those investors paid even 2 months ago. Again, the debt that investors incurred during the recent housing bubble was funded on the debt that they had previously incurred. They used houses that they had bought to fund more houses, and now they can't pay for any of it. You'd think they'd learn, but nope. Economic disaster seems to start that way. Mortgage rates fall, investors swoop in and buy everything. Then rates go up to combat the inflation that follows, and it all ends badly. Of course, in order to keep inflation from skyrocketing, global banking systems will render aid to those corporations who overextended their credit, essentially allowing them to do the same thing in the future. It's wash, rinse, and repeat of 2008 on a smaller scale. The shutdowns during 2020 vastly contributed to the financial crisis as well. Businesses that were forced to close had to lay off employees, causing unemployment to skyrocket. Many of those businesses never reopened. Small businesses couldn't get enough government funding to keep their doors open and pay their people during the pandemic. Globally, growth is expected to slow. The war in Ukraine has already caused food and fuel prices to rise quickly. If we're going to avoid astronomical inflation, efforts have to be made to end the war in Ukraine peacefully. However, that's not the only thing that affects the coming crisis. Global liquidity must be maintained, prevention of economic fragmentation must be achieved, debt management is crucial, climate change must be addressed, and we have to end the pandemic. Really end the pandemic. If growth slows and inflation continues to rise, the most vulnerable population will suffer even more, especially in developing countries. In developed countries, there will be a rise in homelessness, more people will default on loans they can't pay, unemployment will rise, families will go hungry, and those who are teetering on the brink of financial destruction will fall into that chasm. It's 100 seconds to midnight, and the financial crisis looms big over those who couldn't afford to live before inflation rose almost 9%. All caused by the same questionable business practices that have been popular since 1929. I want to thank Kiwi0699 for the 5-star review on Apple Podcasts. I always appreciate it when I see that people are enjoying the show. I also want to thank my friend Eric Carter-Londine of True Consequences for helping me boost my show at the True Crime Podcast Festival. I really wish I could have been there. Thank you all for listening to Cause of Death, 100 Seconds to Midnight, and I'll see you in 2 weeks.